Hey everyone, and welcome back to Elon Musk land. For the past few months, the price of Tesla stock has been the talk of the town. There are claims from analysts everywhere that the price could get even higher than expected, as long as Tesla continues what it's doing. David Lee has claimed that Tesla could hit $10,000 by 2030, but why would he say this? How true are these claims? Stay tuned to find out. David Lee is just another Tesla bull with a YouTube channel on investing. Those of you that know him will know that he is a Tesla enthusiast, and recently he shared a post saying that he will be able to raise his initial Tesla stock capital by about 100 times its actual worth. He says that he originally bought Tesla stock expecting that the value would increase by 10 times, that is, from $3 billion to about $40 billion in market cap. Now, he's recently claimed that history might be just about to repeat itself. But why would he say this? And what exactly is his census? According to Lee, just the same way that people misinterpreted the original iPhone is just the same thing they're doing to Tesla. To him, Tesla is embracing complexity through innovation, and it's just getting warmed up. The investor was greatly surprised when he found out that Tesla stock had expanded by about 100 times in just a little over 8 years. This was all done by simply holding the common stock. This has made him believe that the stock might even go higher, maybe even 100 times more over the next 8 years. If you paid close attention to Tesla stock news, you're going to know that Tesla recently reported impressive figures for their most recent quarter. Given the macroeconomic climate being what it is, Tesla had a successful quarter. It outperformed analysis expectations by $3.32 billion in revenue at $18.7 billion. This was up 81% year over year. While most expected Musk to talk about what's next for Twitter, he instead put all his focus on Tesla. Tesla completely surpassed the expectations of analysis, including those from Wall Street. The company recorded an operating profit of about $1 billion, greater than analysis had expected. Because of this, Tesla shares increased by 5% in after-hours trading, landing at $1,017 per share. According to Lee, most people rely on their understanding of the earning reports to gauge how their firm performed against analysis projections for EPS, revenue margin, and other metrics. He says that there is one main problem with this strategy though, that analysts do not know the majority of their ordinary stock shares. In fact, some of the analysts work for corporations and they don't really own any stock, so it does not really matter if the company's earnings disappoint or amaze these analysts. Investor and analysis expectations for young, high-growth companies are largely at odds. And, however, Tesla stock has actually been confirmed to surpass analysis expectations for a while now. This has become quite true, in fact. If you take, for example, Tesla's first quarter earnings, the figures have gone greatly beyond what the analysis had projected, yet they will have met the investors' expectations. Most financial experts were shocked because they focused on the analysis forecast and how much Tesla had beaten them, instead of focusing on investor expectations and whether or not Tesla had exceeded them. However, according to Lee, Tesla did not actually have the initial momentum needed to keep pushing and hitting new all-time highs. It even merely met, or barely and marginally exceeded, market expectations. After the earnings call and announcement, shares rose by only 6%. This is not really a surprise since most of the loyal investors recently already had high expectations for Tesla and its management, especially for good delivery figures. Lee claims that the prices of the stock is mostly determined by its revenue production. One of the factors that were behind Tesla's first quarter performance was restrictions. It was also one of the reasons that the stock failed to reach an all-time high. Due to the significant COVID-19 containment efforts and a spike in cases in the country, Tesla's Gigafactory in Shanghai was forced to shut down on March 28th. According to Credit Suisse, the idling began at the end of the first quarter. It was mostly expected to affect the company's second quarter performance significantly. This was because the Shanghai factory is the largest in output. However, investors remain relatively optimistic because Tesla's management seems to have everything under control, even with Shanghai's Gigafactory being completely shut down for several weeks. Yet, it produced over half of the company's cars last year. It was mainly shut down because of China's zero-COVID crackdown. According to Tesla, the current quarter's deliveries should be flat as compared to the first 3 months of the year. During the course of the year, it's expected that Tesla will supply about 1.47 million units. According to Lee, if Tesla wants to maintain its bullish rise every quarter, then it should show revenue growth. Tesla should deliver more automobiles than investors anticipate, just as revenue should also exceed expectations. This will eventually drive the stock price higher. Since Tesla has said that it wants to increase production by 5% by next year, it makes sense to expect the stock price to go up. Dave Lee is not the only one who seems to be enthusiastic about Tesla's growth by 2030. Worm Capital also had a lot to say about Tesla in its Q1 2022 investor letter. They anticipate that Tesla shares will provide investors with roughly 10 times the return by 2030, if not significantly more. This is the firm's largest holding and has become increasingly optimistic in the past few months. The firm claims that, as a reflection of their increased confidence, they've managed to increase their Tesla holding in Q1. Their prediction is that Tesla will outperform the S&P 500 in the long run. The firm stated that Tesla still has at least 10 years of development ahead of it. It's just getting to the point where it will start to grow quickly. This is similar to how Amazon came out of the Nasdaq bubble and the financial crisis. There were also some other intriguing projections for the electric vehicle brand's future from another Tesla inventor, Gary Black. He argued that Tesla's market capitalization should be about $4 trillion. Currently, it's worth $756 billion. According to Black, by 2030, global electric car penetration will have reached about 6%. By then, Tesla will have a 20% electric vehicle market share. And in addition to this, Black also said that by the end of the decade, Tesla would already be delivering about 10 million vehicles per year, with worldwide light vehicle sharing rates of around 85 million units. However, things might get worse before they get better. According to some analysis, Tesla's stock price went from a high of $1,152 all the way down to a low of $902 in April. This was, of course, accompanied by many ups and downs, all around the crucial $1,000 level. But where did all this turbulence come from? Just as Apple and Microsoft had demonstrated, investor sentiment is slowly shifting away from high-tech stocks. On the other hand, the frequent COVID-related shutdowns in China are cause for alarm. With the current situation in Shanghai, it's difficult to see how Tesla will meet its delivery targets. On Tuesday, Tesla bull Dan Ives of Wedbush highlighted some concerns in a note to clients. Ives claimed that the key concern for tomorrow is the severity of China's manufacturing troubles and how this is going to affect delivery in the second quarter of the rest of the year. One analysis places Musk in a bad spot because there are so many unknowns that are surrounding second quarter China production, and they will definitely weigh on guidance for the rest of the year. As a result, there's been an obvious overhang on the stock over the past few months. Cathie Woods, a superstar stock picker and longtime Tesla bull, seems quite unhinged by these concerns. According to ARK Investment, her firm, Tesla shares could be worth $4,600 by 2026. Not so long ago, the company predicted a share price of $3,000 by 2025. In a previous report, the bull scenario forecast a price of about $5,800 by 2026, while the bear forecast a price of about $2,900, which is still more than 3 times the current price of $1,500. Even in a worst-case scenario, ARK still expects Tesla's value to be more than 3 times that by 2026. In a note to investors, the investment company said that even though they're calibrated to their 2026 estimates, they still believe that their Tesla model is methodologically conservative. They have also said that they assume Tesla stock will trade like a mature corporation rather than a high-growth one in 2026. According to Tasha Kinney, one of the ARK analysts, the anticipation that Tesla will have more capital that's efficient is crucial. And because of this, Tesla's capital investment per incremental unit of capacity has dropped from $84,000 in 2017 to about $7,700 this year. Dave Lee has said that he is in it for the long run when it comes to his stock. He continues to believe that Tesla will see spectacular growth by 2030. His faith also seems justified, and with all that Tesla has planned for the future, we can say that it just might. So what are your views on Tesla's stock price? Let us know in the comment section down below, and while you're here, go ahead and click on one of these 2 videos on your screen. See you there!